So it was just over a year ago that the World Health Organization declared the coronavirus pandemic. Markets continued to sink aggressively after that, right up through March 23rd. And then we started to see the rebound. But if you look at it on a last 12 months basis from the end of the first quarter, okay, admittedly, this is after a sell off. We had just incredible returns. It tells us a couple of things. One is that, I mean, there's the old saw, don't fight the Fed. Well, don't fight asset markets when governments are pushing trillions of dollars into the economy. So what can we look for going forward? You know, one of the things that people will almost invariably say when discussing the outlook is it's a very uncertain environment. That said, there are a number of things that we can state with utter certainty over the next couple of months. And the first one is that vaccine distribution will continue to accelerate in the United States. And as a result, we're going to see just a huge increase in economic activity. And hand in hand with that, we're going to see a big increase in inflation measures. And then the third thing that we can state unequivocally is that earnings are going to soar for many of the companies. The more interesting question is, how does this continue after that initial spike in enthusiasm and ebullience, if you will? There are, of course, some other politically or government-inspired issues that are entering the calculus, and will have an effect on not only how the overall market performs, but also when you look at things like the infrastructure, will have a significant impact on the types of companies, the sectors that we see the strongest performance.
Thus far, 2021 has been really defined from a fixed income perspective by a dramatic rise in treasury yields. So the steepening trend that we first started to see last November after the election and the announcement of COVID vaccines has continued and intensified. Basically, markets have been adjusting for the prospects of supercharged growth and even potentially for higher inflation. So you've seen the long end of the Treasury curve rise 77 basis points up to about 2.4%. This is in line with pre-pandemic levels. Treasuries have seen their worst quarter in the past 40 years.
During Q1, the yield on the US 10-year note went from about 0.9% up to 175. You know, that had the effect of perhaps lessening the allure of some of the technology companies that had done so well in the previous year. A lot of those companies have long growth runways, and they were the only things in the market that it allowed investors to look beyond the horizon of the pandemic and kind of into the long-term future. When interest rates were really low, the value of that future growth became more attractive. And likewise, when interest rates began to rise, the allure of those long-term earnings gets squished a little bit with the rise in discount rates.
Rising treasury yields also had a wider reaching implications beyond fixed income. We saw increasing demand for US dollars and weakening demand for gold as the opportunity cost of holding gold had now gone up. While yields were increasing, equity markets such as the S&P 500 seemed to hit the pause button and wait to see how to value this volatility. This led the S&P 500 to largely trade sideways during the peak of volatility from February to mid-March. As yields seemed to level off at the end of March, equities found renewed strength. The market seemed to have valued this newfound equilibrium, but we remain vigilant that trouble could be lurking beneath the surface.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting sextantfunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Sextant funds in a free prospectus or summary prospectus, please visit sextantfunds.com or call 1-800-728-8762.